Thanks to everybody who's decided to let go of their mundane daily work and join me on this webinar, which is the VC view on early stage investments. I'm joined here by Christian from Early Game Ventures. He's a founder and managing partner. And we've got Struan from Valuations Venture Partners, also a partner there, who will share with you today's perspectives on what early stage investors look for in a startup overall. We'll delve into the details of how to prepare and approach a VC. We've got certain milestones of a funding round we will share with you. And we will be talking also about valuations and what post-investment strategies might entail. Without further ado, I'd like to give the floor to Christian for a short intro of himself and also Early Game Ventures. I think it's very important for the audience to understand your investment thesis.
Sure. Thank you so much, Angel. Cristian Munteanu, partner Early Game Ventures. We are the typical VC fund, currently investing from our second fund, the 60 million euro fund that we launched in April this year. So we are just at the beginning of our active investment period. Already made the four first investments this year, and we are a generalist fund. Of course, we have several industries of choice, industries that we like more than others. And in terms of deployment, the plan is to deploy half of the money in Romania and half of the money anywhere in Europe. Myself, I have a background as a founder of tech startups. I started more than 10 years ago, in 2013 to be more precise. And I had several startups. The first significant one was a travel tech company that I initiated in Romania, but very, very soon after that, just a few months into it, I had to move to the US. For a variety of reasons, including the lack of capital at that time in Romania and in the region.
Has this changed now? Do you think there's more capital these days?
Oh yeah, absolutely. When we discussed about 2013, there was practically no VC fund at that time and just a handful of very brave angels. So now everything has changed. Now, if you ask me, the capital is sufficient at this moment. Of course, there is always better to have more money at your disposal, but the capital is sufficient. What we need more than money is good startups.
Okay, great. I'll pick you up on that point afterwards, but let's first introduce Struan as well.
Hi everyone, my name is Struan Nin. I'm based in Sofia, Bulgaria. I'm an investor and entrepreneur for quite some years. I've created more than 5 companies myself. Some are product service companies, and I've done M&A and VC starting from 2013. And my first startup was 15 years ago in 2009. We started Valuations we started to prepare Valuations as a fund at 2017, and 2020 we started investing, and we finished our first fund with 107 deals. Average ticket was 200,000 euros, and the deals were between 50K and 1 million euro per company. Quite generalist fund. Keeping in mind we are focused on a geographically focused, so we are investing in this region, more in Bulgaria than not, but that will change in the future, hopefully. And we have quite a wide selection of portfolio companies, and as you can imagine, 107 companies. There are almost no industries where we have not been exposed to. We reviewed more than 2,500 startups in order to come to these 207 investments, and we are helping these companies in various ways to grow and expand.
Excellent. Thanks a lot for this intro. The common thing between Valuations Ventures and Early Game Ventures, as the name suggests, is that they look for early startups. So pre-seed, seed stage, I don't know if you guys have certain deals that are later stage, pre-Series A. Any of you guys? Or maybe Series A?
We do because, with tickets that are up to 1 million, we can participate in even larger rounds. So some of the rounds that we have participated are 5 million. So the companies are really diverse in terms of traction. So some of them when we invested, they were just an idea, and others had already 10 million of revenues, and they could be considered Series A.
What about you, Christian?
Us as well, because we participated in follow-on rounds, later stages for the companies in our portfolio. Otherwise, the initial ticket for us with the second fund would be in the range of 1-2 million, but we can go up to 6 million. Of course, it's very unlikely for us to lead the Series B round as our first investment, but for sure we'll participate.
Great. Without further ado, I'd want to delve into the actual webinar's topics, but I strongly encourage you guys to make it interactive. And how do you make it interactive? By using the Q&A section. I think there's a button. Yes, I found it, Q&A button here. So there are no open questions at the time. You can use it either Q&A or the chat section. I'll be reading all of your questions that you have. I strongly encourage you to take this opportunity and ask the questions live, but obviously afterwards, we can summarize any questions that you might have afterwards. So, this being said, the first topic of today's webinar is what early stage investors look for in a startup. That's a very generalist question. I think more often than not, I see people say the team and then the idea. They put different weights, but I'd like to hear your opinion, Christian. Maybe we can start with you.
Well, what investors are looking for at the early stage in a startup is, in my opinion, is a convincing team, a team that can convince and be how should I say that? It should gain your trust as an investor, right? The team should be able to transmit trust and competence and commitment and dedication, desire to build something ambitious. So the team, of course, is super important. And the second thing is that this team should be working on something of interest. All investors have industries of choice. All investors have their own investment thesis for specific verticals. And there must be the click between what the startup is working on and what the investor is looking to invest into in the market. And for example, I'll just give you one simple example, and I'll pick the agri-tech, okay, technology for the agriculture. I am interested in this vertical, but I'm not interested in any kind of startups that are very hardware intensive in agriculture. So even if the team may be convincing and very competent and with a long experience in this field, if they are working on a very hardware-centric idea, is not a fit for us. But otherwise, this is the two most important things: the team working on something relevant.
Okay, what I'm hearing is that some sectors are more favorable than others, and you would be looking at. Okay. Okay, so agri-tech is something that is not common?
Agri-tech, well, I think that, to be honest, I'm more in love with the idea of investing in agri-tech. Because if you look at this industry, in fact, what's happening in agri-tech is the farmers, they only have the resources to acquire software service when they harvest, right? So towards the end of the year, once per year. This is why it's so cyclic. Everything in agri-tech is so cyclic. On top of that, in the lifetime of a farmer, this farmer only has money 40 times, right? So it's extremely difficult, honestly, to move fast as an agri-tech and to be able to ensure those kind of venture returns that we are interested in. And I would say also that education is an industry somehow similar to agri-tech, right? Other industries, let's say cybersecurity, they don't have these kind of constraints, and they may be more appealing to a VC investor. So, but this is embedded in the very nature of the industry and in the very nature of the business model specific to those industries that make some startups more appealing than others. It doesn't mean that investors don't invest in hardware. There are several investors in this world that only invest in hardware. So each and every investor, they have their own focus areas and also their competence areas.
Got it. Struan, from the perspective of VitoShare, what is the quintessential thing? And I know there are questions popping up, but I'll address those in a second.
For us, one of the first things we want to see in the team standing in front of us is that all the assumptions and ambitions and visions are reasonable. So in simple ways to say it, we want to see common sense, which it's a cliche. We know that it's not very common, because once you see that the assumptions and the ideas that somebody have are reasonable, then you can project this way of thinking, or let's say reasonable way of thinking, into all other aspects of their plans and future actions. For example, we want to see a solution that's reasonable for the market. We want to see how does this team suggest a solution that people would actually pay money for, because many people are delusional of what people would pay money for, and they think that their idea, it might be something useful, efficient, but it's not a big pain, and it's not a big pain for people with deep pockets. Of course, we want to see large markets. We know that small solutions for small markets it's the absolute no-no, but great solutions for larger markets, of course, is the ideal dream for us, which is rarely the case. But we want to see a large market, and we want to see a plan and a strategy and capability of the team to approach this market. Because if we asked, are you going to sell to, how are you going to sell out of Romania or Bulgaria? And they say, yeah, we plan to expand in Western Europe, and then nothing else. And if that's the plan, of course, it sounds delusional. It sounds delusional. It sounds really like this person is just bullshitting. But if we hear, yeah, we have agreed with one friend of ours in Germany to start building partnerships. It's going to cost us 5K per month, and we believe that they're going to close. They're going to approach about 100 companies per month and close about 5%. Then we see that this team has a vision. They know exactly what they want, and we want to get into the details of the vision and check whether these people are living this startup idea, living this dream, or they have just created a deck that checks some boxes.
Right. Some of the most careful listeners actually popped and picked you up on the definition reasonable against realistic. I am often blamed that whenever I see a pitch deck which tells me that it's going to be a new Google or whatever, I tend to do not agree with the assumptions. Let me put it more more bluntly, but I'm often blamed that startups from across the pond in Delaware or elsewhere tend to say that they can conquer the world, and that's perfectly fine with local VCs in the States. Whereas VCs here in Europe, I see, are more, how shall I put it, pessimistic or more realistic, whatever the definition you want to put there. Do you often have certain even regulatory requirements to slash those assumptions down and try to see what is actually, not suggestive, not hope value, but realistic?
It's not a regulatory requirement, but it's our main going due diligence to basically check assumptions and for whatever we don't know to make our own research and validate these assumptions because yeah, even a simple mistake like somebody assuming that they're gonna pay per click in advertising €1, but it may turn out that it's, for example, €20 per click because the industry is so competitive, can really be detrimental for the whole business and the whole marketing plan. So yes, we want to check everything. And may I add two other things that are really important for us to see?
Sure.
One is energy and sustained energy and dedication, because even great founders with great ideas, if they cannot have energy throughout the years ahead, it would not make sense, and it would for us, and we would like to really stay away from people that are maybe really good in a sprint, but are not prepared to run a marathon that can be 3 years, 5 years, 10 years down the road. So we want to really see evidence of dedication, and we really want to see evidence of traction, because there is nothing more that gives us more confidence in a team and a startup than already evidences that these guys want to work on it, they want to be invested, they want to spend their time on the startup, and that people want to buy it. So any evidence
let me pick you up. Let
Yeah.
me pick you up on this point. What if it's
Yeah.
a first-time founder? Where do you get this traction from?
Yeah, you can, for example, talk to a developer or convince some developer, even if you have no money, to create whatever they can. Maybe your cousin is a developer and you really gave him 10% for them to build some part of the MVP, or you spoke to a partner, spoke to customers. Actions speak louder than words, and seeing that this team has done everything possible in their hands before talking to us is really what we want to see. Because the other end of the spectrum is people that have just spent 10 hours on a deck and nothing else. They have not talked to customers, to partners, to programmers, and they just want to get funding and they want to start with it.
Got it. I'm sure you can point out who they are, and they can rarely go to another VC because VCs talk to each other. So that's not a recommendation to you guys, whoever is on the webinar. Don't do this. If you allow me to sum it up, because we need to move to the other topic, what I'm hearing, gentlemen, and please feel free to pitch in. Founders at a seed stage need a blend of resilience, adaptability, and vision. Obviously, they need some form of vision. So the early journey is very challenging. What you're looking for is some dedication. Struan, I hear you. I can relate to that. So those who succeed are often highly adaptable. They're able to pivot based on market feedback, is another thing that I've got written down. And yet they're grounded in a clear mission and long-term vision, so where the solution wants to go. So I think that those are the critical things that need to be demonstrated anytime you speak with a VC. With that, I want to open on the Q&A because we already have a few questions. Bogdan, I apologize. I may not be pronouncing your surname correctly. Neasco. So Bogdan is suggesting the following, that at a pre-seed funding is often through angels rather than VCs, and that has taken place already. Has this changed? Or do you see funds available for very early stage, like you suggested, like an idea stage?
Well, I would argue that this is not correct. No, of course, angels are investing small tickets typically at the pre-seed stage, but we are doing a lot of pre-seed ourselves. I mean, the first 4 investments, as I said, that we made this year, all of them are pre-seed investments. So we invested in 4 teams, pre-product, pre-revenue. You cannot invest earlier than this, right? And that, once again, with tickets of 1 million.
Got it. Okay, so the answer is very affirmative. And there's a question directly to Struan. Are you still making new investments for the actual fund, which is Fund 1? And if yes, for how many months, years are you starting preparing for the second fund? I think I can answer that, but please go ahead and answer it.
So our investment period ended end of 2023, and we are in advanced process of preparing our next fund, which should open hopefully in Q2 next year. And it would be slightly larger ticket, slightly larger fund, hopefully. So we expect something like a 35 million fund in Q2 next year. We are not
Excellent.
investing at the moment.
Brilliant. Looking forward to it, to have mutual deals. Because as far as I understand, this is straight from the kitchen, as we say here in Bulgaria. The two guys from the different funds don't have a single deal together yet. So maybe next year, guys. Mihai is asking the following question, which is, I think it's brilliant. Is one of my questions as well. Let's not wait and ask it now. How does your team actively support founders? Really actively support in areas like growth? Can you provide examples of how you've helped software as a service companies, for instance, to scale?
Sure, absolutely. There are very hands-on investors and other investors that prefer to be light touch, right? So this is also reflected in the investment documents. If you are an investor that is hands-on, typically you have all kind of clauses in the investment contracts, giving you rights. For example, for any kind of expenses larger than 50K, let's say, you have to ask the investor and to have the approval of the investor for that. We don't do that. So our approach is, I would rather say, light touch, in the sense that we do not have any kind of any say on the operational side. In the end, we are a minority investor, and the founders are the larger shareholders in the company. Is their company still, right? So they are the operators. They are making the calls. They are making all the decisions, and in the end, they go whatever way they feel is the right way to go. That being said, we are there to help. So the philosophy is to help with whatever is needed and nothing that is not required. Because I said this several times. It's a quote from Vinod Khosla, the legendary VC, American VC. And Khosla said that 70% of the VCs add negative value to the portfolio companies. In other words, 70% of the VCs do harm to their portfolio companies. Of course, they don't do it intentionally. They don't want to harm the company, but they do it unintentionally anyway. And keep in mind that when Vinod Khosla said 70%, he was referring to 70% of the American funds. I would argue that the percent is higher in Europe. So once again, that being said, we are there for our portfolio companies to help with what they need. And typically they need intros to partners. They need maybe a bit of help on recruiting. But nobody, in fact, is trying to convince a VC into doing the sales for them. And the VCs, they don't do the sales for the team. This is something very important when you evaluate a startup to invest in. If you realize that they have absolutely no idea how to sell the service, you simply don't make the investment. You invest in companies.
Christian, but I'm sure that you will pick up the phone and answer and call some of your partners and say, listen, by the way, I have this portfolio company and it may be a beautiful partnership. I'm sure you do that, though.
Oh, yeah, of course we do that. Once again, when needed, when required, and when accepted. But I also see the opposite reaction. I see founders that don't want to be bothered, don't want to be deviated from their plan, and they prefer to be simply left alone. And they have the right to be so, right? So once again, it's their decision how they manage the company. What we can help, we can help with a lot of things, starting with, I don't know, all kind of perks like free cloud computing, a lot of services, discounts, perks, and networking introductions to clients, to partners, to other investors. I've been doing in recent years a lot of fundraising on behalf of our companies. So I introduce regularly our companies to many, many VCs, both in Europe and in the US, depending on their interest. So we're doing a lot of stuff. I'm traveling together with the founders in our companies to different events and different meetings. I'm visiting their offices if they're not in Bucharest, or if they are in Bucharest. So yeah, we do a lot
Christian,
of this.
couple of questions just for the audience to make sure that they put it in perspective. Do you act as a lead investor ever?
We are always the lead investor.
Okay, but you're always a minority investor as well.
Absolutely. All VCs typically are minority investors, minority shareholders.
In your investment thesis, do you have like up to 30% or something like that as a threshold?
15% equity stake is what we target. 15.
Okay, and how many startups have you funded so far?
So far, 28 from Fund 1 and 4 from the recently launched Fund 2. So in total, 32 companies. The target with our second fund is once again to invest in 30 companies, 30.
Brilliant. Thank you. Struan, back to you. Is there anything you want to add to that?
I would say really decide what you want from an investor, because investors are different. Indeed, that's as Christian mentioned. Some of them are more willing and able to help. Others are more like just money, smart money versus just money, and versus, as Christian said, negative value money. I'm almost surprised at these statistics, but I think it's very possible that it's true. Like 70% are giving negative value. Hopefully, this doesn't scare you away. And I'm glad to note the coincidence that both of our funds are making the other 30%, which is great. And I would say you can expect that VCs will use their network. I think the main point to look for is really fundraising contacts and some partnerships, business development contacts. But also keep in mind, have realistic expectations about this, because we don't want we are where we are because we know how to use our network, and we would not give something that's not relevant to our network just because we invested in you. So if your solution is not validated, we would not speak to our corporate contacts and give them something that they would not talk to us or not take us seriously after that. So have realistic expectations that when you have something of value and something really amazing to show to the world, your investors can be one of the doors through which you can do this, but not more than that.
I'm very worried that we are still on the first topic of our webinar, half an hour down the line. I see a lot of questions. That's great. Keep it going, guys. But I will quickly address one of them, because Stephanie is asking how important is the existing VC startup relationship in order to receive funding, and what would you recommend to start building one? I'm sorry, but that's obvious. Yes, go ahead, build a relationship now. If you haven't started, it's already late. That's my quick answer on that. Leverage all the connections that you have. People should be talking about you around the ecosystem. I will address the other questions as well, but I'd like to move to the next topic of today's discussion, which is, let me open up my notes, how to prepare for approaching a VC and for an investment round. Brilliant. That's exactly what Stefan was asking. So how do you prepare that? Anyone? Christian, Struan, who wants to take the lead this time?
Sure. This is something that I touched on several occasions, different speeches, even articles. And I was saying that in Eastern Europe, in Europe at large, founders still need to learn how to do their own due diligence of the investors. So just as the investors are doing the due diligence or the verifications or the checks on the founders, the founders are also supposed to do the same thing on the investors. And the most efficient way, the most effective way to do it is simply to call founders in which that VC invested already and have a chat, a friendly chat. Just ask the other founders, ask your peers, hey, how are you working with this investor? Is he helping? Are they keeping their word? Ask anything. And the founders are open, the founders are transparent, they want to share this kind of information. So this is an advice that I give all the founders that we are discussing with for a potential investment. Call anybody in our portfolio, have a chat, and don't ever tell me who you discuss with. This is the best way to do your DD.
Okay. Struan?
Oh, I would say just like any sales process, you need to, in sales pitch, you need to start with the customer's goals in mind. So in this case, when you talk to a venture capital fund, you should think what their goals are. You should see, is that an angel investor? Is that an accelerator who wants to just have a nice cohort and nothing more? Is that somebody that wants to make 100 million exit? Is it 500 million exits? Usually, the larger the fund, the more they are going to be looking for 100 million plus stories, because you cannot. We keep in mind that we rely on just on a few successes, just a few successes to return the whole fund, and we cannot make this with small success stories. You cannot sell your company for 20 million and we will have a stake of, let's say, 10% at the end after the illusions, and we will return 2 million, and that's like nothing for a larger fund. So first of all, decide what you want from your company, from your vision, and decide whether larger VC funds are the right thing for you, because you don't want to be selling unicorns where your business potential is to do a 10 million business, because the dissonance between what you want to sell and what you can actually it's possible to do is going to be too big. But keep in mind that VCs want to 10x their money. So if you're asking, let's say, to raise 500,000 on, for example, 3 million valuation, okay, 4 or 5 million valuation, prepare for the meeting that you'll be building at least a $50 million business. So have the projections for 5 years ahead. Show that you have planned this 50 million business, not the 5 million business that you are selling right now. So if we don't see the 50 million at least business a few years down the road, it's nothing of value that we get.
Okay.
Yeah.
Unintentionally or intentionally, I don't know, but you actually addressed Marius's question. He's saying the following: venture capital funds are by definition focused on high risk investments, yet many funds seem to prefer late stage investments to minimize risk. What are the main obstacles you see in investing pre-seed startups, even when they have a promising business model? And in this context, what could a startup do to become more appealing to you before reaching, let's say, MRR of 10K, 20K, whatever it is?
I would say the more evidence of traction we have, the better. This could be market research. It could be ability to pre-sell something, so that somebody promised you to pay you when the product is there. You convinced partners to sell your product. You have a letter of intent from a large corporation that they find use of your product, or a partner that says that they will be able to sell your product to hundreds of their businesses. So any evidence, we look for any evidence. We want to invest, right? It's not like we want to keep the money in the fund, but we want to check as many boxes. We want to see as many evidences as possible that this is going to be a valid business and you are reliable people dedicated to this business and you are capable of achieving it. So any action that would make you closer to having a viable business is for us an evidence that gives us confidence.
Brilliant. Christian?
Well, I said it already. We invested all our investments in our second fund are in companies pre-product, pre-revenue. None of them are making any kind of money. Not 10,000 per month. None. Zero. So yes, we do pre-seed investment. It doesn't mean that, just as Struan said, if you make a deck, that's enough. Because none of these companies only have a deck. They build the product, they are building the product, they are doing a lot of other things. They're not just putting together a presentation and then raising $1 million.
Do
right?
you invest in hardware at all, or do you invest with a company there is a hardware component?
We invested in a company with a very strong hardware component in Fund 1, yes. In Fund 2, we didn't have the opportunity yet. To be honest, I didn't meet many hardware-centric startups
Got it.
in the recent years. Hardware is hard. Well, it doesn't mean that we are not looking at it. We are looking at it, but in order to make an investment in a pure hardware play, we should be very, very convinced that that investment is making a lot of sense. Otherwise, just think of the business model. For any companies that have a hardware component in their product, it means a lot. It means a lot in terms of supplies, in terms of the value chain, in terms of service. You have to service that hardware component, right? How are you going to do that? If you have valid answers to all these hardware-related questions, of course, it's investable. Typically, usually, it's very difficult to have answers to these questions.
Got it. Okay, so I'm going to return back to the main topic, which is how to prepare for approaching a VC. And I think it's very important term of that is to prepare with your pitch, right? A compelling funding pitch. And a compelling funding pitch, at least for me, means something that it's clear, that it's brief, and it has an impact. Trust me, guys, and that's an advice to anyone here in the webinar. These guys look at thousands and thousands of pitches. So if you don't catch their attention in 10 seconds, they're not reading the rest of it. So what I see as a very valid strategy, some of the founders that have come to me, they prepare sort of a one-pager or an executive summary of the things they do, things they look for, and how they solve the problem. And once you have that clearly outlined in an A4 paper, then you catch the attention. And then Struan and Christian will go into the details of the deck, of the presentation, of the business plan, what have you. But that's something that I found very appealing. And typically it's done by foreign startups rather than the local ones, I think. I don't know if you have certain observations which match or disprove this thesis.
I would say that really I encourage you to really go very deep in while developing your deck. Because guys, the deck is a magical instrument. It's a magical thing, and it's not a coincidence that this deck is a standard pitching instrument all across the world, in all geographies, all sectors. Because the basic questions that a startup deck answers are really the big questions that an investor has to know, and also the big question that a business an entrepreneur should know, research, and plan. And the depths in which you understand the different different modules of your business plan, of your startup deck, show us basically your seriousness in the business, your understanding, your research, your work, because we want to see. And it's really important for us that nothing is missing, and there are no holes in the story, because it could be that you have a great business model and a great product, but you didn't research well the competition, and it's full of competitors at low prices, and there is no business. Or it could be that your go-to-market strategy was not thought well enough, and you created this nice vision of a product, but there is no way for you to sell to, let's say, the banks are your customers, and sales cycle is 1-2 years, and you didn't plan for this. So for us, it's really important that none of the components from a pitch deck is missing, because it could be that you have 19 components there, one missing. This means that the whole business could be going to trash. And it also shows us that if you didn't think and explore well enough one of the components of the pitch deck, it could be that you're not really living this business. You're not
Okay, but
living
how
the story.
important it is to set up a data room, for instance, with all the relevant documents, like not just deck, business plan, things like that,
Depends on
marketing,
the
go to
stage.
market.
Depends on the stage. But so for the more advanced companies, of course, the more data they'll have. But just the main assumptions on all, like finance, plans, go-to-market, product, team, competition, solution, etc. They should be there.
Okay. I need to move to the next topic, which is milestones of a funding round, including expected timing. So when should anyone approach you guys? What are the milestones that need to be achieved? If you can give me like certain thresholds, like in terms of traction or other relevant metrics, like how much MRR for pre-seed, seed, or Series A, like Christian said it 3 times, I think already, that in their first fund, none of the companies actually are making MRR yet. So what are the thresholds you look at, and what is the timing? What is the right timing for anyone to approach you?
We had the exactly same story with Fund One. Initially, when we invested in practically all the companies in Fund One, none of them was making money, right? And now, 5.5 years later, companies in our portfolios, they make more than 45 million euro in revenue annually, right? So we invested in, let's say, we invested in ideas, in stories, in what they intend to plan, what they intend to build. And today, our portfolio consists of 2 businesses generating a lot of revenue with more than 400 employees, right? And we are doing exactly the same thing with Fund 2. Investing companies at a very early stage, companies that are making no money at all. Traction, because Stoyan said something important, traction doesn't mean only revenue. Traction also means all the effort that you make in order to find the right co-founder, in order to deeply understand the problem, in order to have a dialogue with your customer. So all the efforts that you make, this means traction. This is an evidence that you are not just talking, but also doing something. And this is important. This is fundamental for us when we invest at the early stage. Of course, I'm not expecting you to already make €1 million monthly recurring revenue in your second year, right? If you are making 1 million, it's too late for us, and I'm not going to invest there. I don't want to invest in a startup that's already making 1 million. I want to be the first institutional investor in a startup that in the future, after I'm invested there, will make the 1 million, right? Because if I invest early, I take a lot of risks, but at the same time, the price for me is going to be much lower. And just to give you an example, we invested in Druid at around 7 million euro valuation, and the company is raising at 230 million today, right? And we were the first institutional investor in the company. I don't want to come late, to come to this Series C right now and invest in the company when they are already making 22 million per year in revenue. It's too late for me. It's, in my opinion, and I don't want to be dismissive, but in my opinion, it's easy to be an investor and to invest only based on revenue. It's enough to be a good accountant, and that's it. You'll be able to make investments. Late stage investing is not for me. I don't like that part. It's just pure technical stuff. I like the early stage. I like to discuss with founders, to analyze startups, to make investments when they are just a promise. And I like to be right, to be proven right 1 year, 2 year, 5 years later. I'm sorry, I went too far from the question, right?
You didn't. You actually beautifully transformed to the next topic, which is valuations and round sizes, because I think we never talked about it. How much should you ask for and how much equity to give away? That's a question that I personally am asked all the time. And sometimes people come to me with a cap table, an estimated cap table, and then it turns out that because of their structure of the cap table, there's far too much dilution. So how do you evaluate a pre-revenue startup in terms of pricing?
Pretty simple, in fact. So our target is to acquire 15% of the company, 15, right? So we are engaging in a discussion.
So they retain 75%, 85%.
85%.
85% after each. No, that's the first round.
The first round, yes. I'm discussing about the first round right now. So our intention is to acquire 15%, and we discuss with the startup. If we like the startup, if we see the opportunity there and we want to invest, it means that it's of interest to us, that we see a potential there. So practically at that moment, we engage in this negotiation. So how much money is the startup raising? What is the use of funds? How long is the money going to last? And we'd like to see a runway of at least 18 months, right? What is that very important milestone that the startup will reach after they walk through the runway, okay? And then the question of valuation. Okay, so what's the valuation of the company? And then the importance of the opportunity comes into play. And for us, it's absolutely normal to pay 1 million euro for 15% in a company, or to pay 200,000 euro for 15% in a company is the same, or to pay 3 million for 15% in a company. It's absolutely normal to pay different prices for the same equity stake, because each and every company is doing something different in a different way, with different people, a different technology. And what we evaluate is, okay, how big can this company get? If a company has the potential to be 5 billion at one moment, yes, it doesn't make much difference if the valuation is 9 million or 15 million.
Got it. Before I give the floor to Struan, I personally stopped looking at DCFs long time ago. I don't think it made any sense whatsoever.
Yeah, it doesn't work in VC.
Right. I don't think so either. But what I do look at is exactly what Struan said, the assumptions, whether the assumptions are clearly spelled out, thought through, because there are risks. And what I'm constantly looking at how those risks are being mitigated, rather than just, pointing out, oh, there's a, political risk that somebody wins the elections across the pond or something like that. Struan, do you want to take this? Valuations.
Yes, our way of looking at things is very much in line with what Christian just outlined. So I'm glad that we have similar standards, and you should see that VCs generally have similar vision of valuations. But indeed, it's a difficult question for you, because from startup point of view, you want to raise as much as possible. And when we ask what's the valuation, as much as possible is again the answer. The truth is that you need to be, again, realistic and have common sense and know what you bring to the table. And in one case, you bring just an idea. In the second case, you bring a whole team. You can bring an MVP. You can bring strategic partnerships. You can bring industry positioning, because maybe you have a certain way to position yourself in the industry that you want to sell. So you need to know what you bring. Is your team made of successful entrepreneurs that have done multiple exits, which lowers the risk for us? Do you have already vast experience and contacts and positioning in this industry? This also lowers the risk and gives us more security. So the more things you put on the table, the higher the initial valuation can be. Of course, if you have evidence of product market fit or other forms of traction that we just discussed, this all minimizes risks and make us um, able to evaluate your company at higher valuation. But indeed, and like a pre-seed seed round can go, the range can be really wide. It can start from 1 million valuation, or it could be 15 million valuation. And again, the rule of thumb would be, as Christian outlined, what's realistically, without being lavish, you will need in 18 months just to follow your plan. You might be building an MVP at the moment, or you might be already selling, or you might be growing your company internationally. This brings very different expenses for the next 18 months. So try to have this approach. Be realistic of, if you're using your own money, uh, let's say relatively generously, your own savings, what would your strategy be in the next 18 months? How much money you would allocate? What kind of people you must hire to execute your strategy? Then make this pile of money. Decide how much money you need, and then make this to be from 10 to 20% of the company valuation. This is a good rule of thumb. Of course, it's not the only way to do it, but this is how we would look at it fairly, and we wouldn't say, okay, you're asking for something unreasonable.
Okay, am I right to suggest that in terms of percentage of equity you are looking at the very early stages, again, just like early game ventures, around 15%?
It's different because the stages of the companies that come to us are very different. So we have acquired from 5 to 20%, but I would say 15% would be a very good rule of thumb of what we are looking for.
Got it. And one of the guys here, Chris, is asking, is there a rule of thumb for each round of investment? And can you share that with us?
In terms of percentage dilution, it would be something like that, 10 to 20%, where 20 is on the high end. Of course, the bigger you are, the less percentage you want to give away. So perhaps you could be raising your fourth round, and you could be giving away just 5% of the company if it's worth 200 million. But it's more of a function of the runway you want to finance, and keep in mind also valuations happen on the table as well. They are not so much, as you said, Angel, a result of the DCF, but it's how much the investor is willing to give, how strongly they want to invest in you. And if it's really a market. If there are 10 investors lined up to finance you, obviously you can ask for a slightly higher valuation. If you're not knocking on just one door that's barely opened, of course, then the negotiation power is in the investor. But I would suggest, don't push too much on the valuation. Try that the valuation comes from the market and from the round size that you really need for the next 18 months.
Got it. So would you be looking at a startup which is not brand new, it's like 4 years old and is raising a small round, like a bridge round, for instance, because it's doing a pivot? Would you look at that?
Yes, I would look at that, but I will be a bit suspicious. I mean, why are you raising a bridge round? What went wrong? Why did it went wrong? What have you learned from the mistakes? Why are you in this position? Because you already raised, and if you are raising a bridge round, it means that you didn't deliver on your promises in that round. So a bridge round is a compromise already. You are already making an important compromise in your fundraising strategy, raising a bridge round. Why are you doing that?
I saw a lot of down rounds these days, and that's, I think, normal.
Yeah, but we don't look at down rounds. If you are raising a down round, they're not interested at all. I mean, we are not taking a call with you.
I think economically speaking, in 2020 and 2021, a lot of the VCs were too ambitious in the valuations that they were giving out. So I think it's only normal to see some form of coming back to senses.
Yes, but Europe was not that. The heat was lighter in Europe. That was something typical to the American market, investing at a very high valuation very, very early on. And after that, the startup was forced into a down round. Not that much in Europe and even less in Eastern Europe.
Gentlemen, I think we've covered a lot of the topics, including the last one, which is what to expect from the relationship with an investor. I think we can sum it up as to, you name it. You have to be the proactive. No, you have to be the proactive ones and constantly ask if you need support. I think that sums it up. I've got 2 more minutes and I've got a couple of questions which I prepared for this talk. If you allow me to take on those as well. How do you see the role of the local ecosystems in helping startups build credibility? Because people say to me, okay, maybe the Romanian startup ecosystem started building later than the Bulgarian one, but I think there's been a lot of catching up, and especially in terms of not just real numbers, but percentages and real numbers together. I think these days we cannot even compete with the Romanian ecosystem. So how important it is for the local ecosystem to help you with the structure of the startup and then make an introduction maybe? Do you have the likes of, I don't know, maybe Endeavor or other accelerator programs or
Yes, I would say that in the last year, the Romanian ecosystem grew a lot. And currently, the ecosystem is, I would say, quite complete. We have investors, we have angel associations, we have lawyers that got experience into drafting the contracts. We have many support organizations. You mentioned Endeavor. We have others as well. We have groups of investors dedicated to investing in women, female entrepreneurs. So the variety grew a lot. The ecosystem, in my opinion, is not mature, of course. It needs more time to become truly mature, but it's almost complete at this moment. It's never been a better moment in Romania for a founder to launch a startup. Never, ever in the history. The money is here. Everything you need to do is to have a decent team working on a decent product.
Right. Great. Struan?
I would say startups should be really grateful that they can start. Entrepreneurs should be grateful to start in such rich ecosystems. It's a luxury, really, to have so much development money, so many supporting organizations, so much hype about startups. Media is open to promote people with zero revenues and a pitch deck. So there's so many ways that you can use the business environment and the ecosystem that I would say we are lucky to have these things in our neighboring countries.
Thanks a lot, gentlemen. I'm very mindful that it's 1 minute past 4, so I think we can wrap it up here.
Thank you so much. It's been a pleasure. Angel, Stoyan, everybody, thank you.
Thanks
Me as well,
and
thank you.
everyone for the questions. That's what I wanted, a very interactive session.